All right, good morning, everyone, and welcome to today's webinar, Managing Your Business Insurance During a Pandemic and Beyond. We all know that 2020 has been a challenging year for businesses of all size. So we're very happy that you're here to join us for today's webinar, where Jonathan Hines, who is a partner and VP of Commercial Lines at Wilson Insurance, will help us gain an understanding on coverages you currently have and coverages available that may be able to save your business from a financial disaster. So before we start, I just want to let everybody know that they're going to be muted during the presentation. But if you have any questions at any point, just put them in the chat, which is in the little toolbar at the bottom. So any question that pops into your head, stick it into the chat and we'll get to that at the end. If you do have a question and you don't want to put it into the chat, at the very end, you'll be able to unmute yourself and speak to Jonathan in person. And also this session is being recorded and we're going to be sharing it on our YouTube channel if you know of anybody who couldn't make it today and would benefit from it. All right, and so without further ado, I'd like to introduce Jonathan Hines.
Hey, thanks everybody. I know 2020 has been a challenging year for everybody, no matter what industry, business, or region of the world that they operate in. Hoping today to bring a little bit of insight into what the role and the continued purpose for insurance and risk management is in managing operational risk for businesses, and then bring some insight into the really poor timing of the insurance hard market that's driven up costs and access to insurance. So really my presentation is broken down into an agenda. I'm going to explain what the insurance hard market is and how it ties in specifically with COVID-19 issues. I'm going to review really the role of insurance in risk management planning. We're going to talk a little bit about how to gain an understanding of what your insurance program looks like today and what you can do about it. And then there's 4 areas here of coverage that are really amplified in importance by what's going on with COVID-19 and what those financial impacts look like for businesses. So I'm hoping to run you through this presentation somewhere between 40 and 50 minutes this morning, and then leave time for questions at the end. So not sure if everybody on the call has heard the term hard market. It's industry specific language, which I know just adds to confusion generally for almost everybody. So I'm just going to take a minute to explain what that is, what's been going on, and what people can anticipate with regard to placing insurance over what we perceive as the short and the medium term. So if you take a bit of, I guess a look back, 2007, insurance industry was in the middle of a soft market, which really reflects wide open access to a variety of carriers that were looking to build market share, continuing declining rates, expansion of coverage, really a buyer's market for insurance. Probably at the start of 2018, Q1 or so, we started to see an intensification of market hardening. And in simple terms, it simply means that there's less flexibility from insurers and higher pricing. The focus really shifts from gaining market share to profitability and results. With that, there's new underwriting requirements. A lot of people on the call are probably being asked for additional information on their insurance renewals. Some people may be experiencing non-renewal of existing accounts, depending on what business they're in, limitation of capacity and limits, less coverage available, and more stringent loss control and compliance. The most popular question we're often asked is, why is this happening? What's driving this? Why the sudden change? Really, one of the key drivers is prolonged low rates for more than the last 10 years, as insurers battled for larger chunks of market share with less focus on profitability. There's been a pronounced increase in variables that cause a rapid inflation of claims costs. And I'm going to review through the course of the presentation why these are amplified by COVID-19. I think in every industry that there were a variety of challenges that have been compounded by the current pandemic and outbreak. The insurance industry is not different. Climate change has been a rapidly changing environment where we're getting into the Greek alphabet now on named storm coverage. I think everybody now can observe in their operating environment the fact that there's almost no debate now that climate change is a changing and a very difficult force to manage for a variety of industries. We're also in an environment of very low investment return. Insurance carriers, especially in Canada, are very carefully regulated on where they can pool premium reserves. Guaranteed investments and low risk investments are causing very, very low investment return, which causes insurers almost to rely completely on underwriting profit. There's inflation of all sorts of other costs and increased litigation. Most specific to COVID-19, we're seeing significant changes in our clients' businesses that really require careful emphasis and review of insurance programs. We're seeing inventory shortages that are causing our clients to increase stock or to pool stock in inventory levels when it's available, changes what their exposure is. We're seeing vacancy or changes in occupancy in a variety of different industry classes, hotels, restaurants, some commercial real estate, certainly increased cyber and crime risks, lower liquidity in businesses that are using up their capital to buy inventory or to make operational changes, supply chain issues, rapid and frequent changes in building material costs and other types of input costs, reductions in cash assets, and more stringent lending and credit requirements for insurance. And you're really seeing these from banking and financial institutions that are asking for more insurance coverage or more specific insurance coverage in a time where it's less available and more expensive. With this, natural tendency is to look at changing insurance carriers, which comes with its own host of issues that we're very careful to advise our clients properly around what that means. When you're changing insurance carriers, it usually comes with new inspections or loss control compliance. You have a limited history with that carrier. Rate changes and fluctuations are less foreseeable typically with the new insurer. Claims experience with a new insurer can cause issues. Having a new claim with a new insurer in a difficult market is almost a worst case scenario. So we're very cautious of that as well. And non-renewal from some of these carriers, you can easily change to a carrier that's exiting a class of business, and rather than a renewal increase, wind up with a position where we're trying to replace the insurance carrier. The typical client responses that we're seeing from the hardening market that are coming into our office by request or directly from clients are asking brokers to have their accounts shopped or marketed among the insurance carriers in the marketplace. It can be a very difficult exercise because there are limited carriers in the marketplace, fewer options, and risks of changing carriers. Requests for quotes from other brokers. The insurance marketplace isn't as large as often clients perceive it might be. So often when there's multiple brokers trying to market or place a new account, the insurance carriers are simply seeing the same account from multiple brokers, which causes them to lose interest in the submission or assume it's a price-only request, and it accomplishes the opposite goal. They're also looking or exploring reducing or removing coverage, which at the end of the day, most businesses are under more financial pressure and less able to sustain losses. So I don't want to make this into a bad news story. I want to talk to you about what you can do about this, where the focus should be in order to avoid unforeseen consequences, and how we can support our clients as they look to manage this type of environment where they require the insurance coverage, but where it's more expensive. As a business owner, I think the best thing right now for anybody to be doing is looking inwardly at loss control and prevention and making sure that they have loss control in place and can articulate it to brokers, to loss control managers, and to a variety of other interested parties. What this is doing is demonstrating that a business has a plan to mitigate and reduce exposure around claims cost. some examples of what loss control looks like are fleet management, making sure that operators have some sort of guideline or minimum age requirements around operating your company vehicles, keeping good records on what you're doing to update your buildings and property in terms of electrical systems, major HVAC systems, just general maintenance that reduces the possibility of physical loss to a building or structure. Looking at vendor and customer contracts and what risk is entailed in those contracts, what the plan is around claims and incident handling, how that's documented, clear communication of operations, what your business is actually doing in terms of services and its revenue breakdown, and most specifically, if you are planning COVID-19 mitigation strategies, that those are articulated and documented. So I can talk to you a little bit about how Wilson Insurance, we're helping our clients manage a marketplace that we're not in control of. We're spending more time on account reviews and trying to emphasize a clear understanding of our client's business, a very clear understanding of their operations and revenue, very clear details on their buildings and property. We're specifically looking at their coverage. Is it enough? Are the limits sufficient? Do we have all the relevant policies in place that a client may need to sustain physical or financial loss given the current operating environment? We're working first and foremost with the current insurance company to manage costs by deductibles, coverage limit changes, looking to maintain those relationships where there's a greater degree of certainty until the market changes. When necessary, we're working with qualified insurers that have experience and history in different industry classes based on complete underwriting details to get best outcomes. What you'll find, insurers come and go from different industry classes, construction, real estate, and development, but some have been there and are there for the long haul. We're looking at what the history of various carriers is as they service those industry classes, as it really predicts what their position will be going forward. Very easily in a changing insurance environment where costs and coverage are increasing and becoming less available, the focus can be shifted to pricing. Often the insurance pricing in the event of a major loss is insignificant compared to the cost of risk. What we're continuing to do and encouraging our clients to continue to do is not focus on simply a disaster, the most evident causes a loss or what they're seeing, but to understand and manage their exposure to loss or injury being risk. What does that look like in their business? In 2020, that's changed faster than it ever has or than I've ever seen it change. The reason risk continues to evolve and change is legal new precedents. Technology, a very pronounced risk during the COVID-19 crisis, changes in government policy, which we're seeing rapidly now in terms of employment practices, health and safety compliance, changes in the regulatory environment, contractual risk, which is becoming more and more difficult to navigate, in the effects of globalization, online sales, operating in different geographical environments, all changes risk, and it's significantly different for every business that operates. Construction and contracting have service-based or operations-based risk, while real estate tends to have property-based risk. So it's important that there's not a blanket statement, but an analysis by industry class to figure out what are the different businesses' risks and how do they differ among the different industries that they're operating in. Most clients that I come across typically think of traditional risks that are the most visible. Those are external and internal risks like flood, like climate change, like fire, negative publicity, things that we're used to seeing and managing. New and emerging risks, again, during this crisis have amplified. We're spending a lot of time today looking at environmental risk, cyber and technology risks, the costs and effects of climate change, which are making flood and water damage more difficult to get and requiring our clients to retain more risk in those areas, terrorism, and especially employment practices, which I just touched on, which includes the new regime of health and compliance measures that are provincial and federal government are requiring us to both understand, develop practices around, and deploy. From our perspective, insurance really is not a solution. Insurance is just part of an overall risk management plan. Whether your business is large or small, we all have this exercise to go through to identify, analyze, decide how to mitigate and monitor risk. Without going through this process, it's very difficult to design an adequate insurance program. Risk really fits into different categories. For a long time, hazard-based risk was where everybody spent their time. Fire, natural disasters, property losses, financial, operational, and strategic risk are also areas that have significant exposure for a lot of clients and where insurance solutions are available. For a long time, everybody said only hazard-based risk was insurable. Strategic and financial risk and operational risk now have various insurance solutions available to every client. I'm going to go through some of those later in the presentation. The first step really to understanding risk is what can be accepted, what's controlled, transferred, and avoided. Insurance solutions are a method of risk transfer. Essentially, we're moving the risk off of the organization's balance sheet to an insurance carrier. That can include loss of building or property risk by a building insurance policy. It can include cyber risk by buying network security and cyber coverage. What we find a lot of times looking at a new account is that a lot of risks that businesses can easily accept are insured, and many risks that are catastrophic aren't part of the coverage program. A good example are looking at buildings on an insurance program that have a $1,000 deductible in an environment where minimal damages aren't worth claiming under an insurance program, but there's an absence of adequate business interruption coverage or of network security coverage. What we look to help our clients do, especially in this environment, is to understand, prioritize the frequency and severity of risk, look at the various types of organizational risk that are within the business, and the ability of a business to sustain and tolerate risk. What's the borrowing capacity, financial position, ability to mitigate risk, and availability of insurance. Insurance carriers, in addition to claims management and indemnification or insurance of specific risk, can offer a variety of other support services to clients. Those include investigation and support of losses, cyber audits and vulnerability assessments, loss control training and education, property valuations. There's a variety of services available from qualified insurers, free of cost, typically to help clients manage and understand the risks that they have within their businesses. One of the best questions that we're asked is, I'm not sure what I have in place for coverage. I don't really know how it responds. What should I do about that? Most clients will typically go try to procure insurance quotes, which really doesn't serve the purpose that they're looking for. What we encourage clients to do is solicit a written review of their coverage program, get an understanding of critical coverage weaknesses, recommendations of alternative coverage structures, outline and recommend program designs. It requires limited information, and it doesn't interfere with the current broker relationship. So I'm going to go through some of what we would view is the most significant areas that COVID-19 has really affected and changed within insurance planning. Co-insurance and limitations in navigating those clauses and policies have become paramount. So I'm going to explain both what a co-insurance penalty clause is on a property policy, and I'm also going to go through why there's been changes within the COVID-19 pandemic that exacerbate these issues. Anybody that owns buildings or material or trying to buy input costs right now have probably experienced the building material fluctuations. means that what we have now, construction costs, have changed significantly in a short period of time. There's been increases in the valuation of supply and inventory. There's less availability of skilled contractors and trades. There's less availability of alternate suppliers. And COVID costs specifically have added extra expense and increased costs. So the overall takeaway here is that the value of a building built last year or the value of inventory purchased even 6 months ago may be significantly different than it is today and needs to be reviewed. Within most insurance programs, the onus for valuation is placed back on the client. It can be very problematic, especially when that value shifts consistently. So most commercial property and liability policies will have a co-insurance penalty clause that works exactly like the illustration that you're going to see here on the screen. At the time of the loss, the insurer will take the limit carried by you as the client, divided by the value of your property, multiplied by the co-insurance clause. They'll multiply that by the amount of loss, and that is the claims payment. So in the example here, if we have a building insured for $500,000, the actual replacement cost is $1 million, and the policy carried a 90% co-insurance penalty. The payout on a $400,000 loss is $222,000. There's a real need to understand updated construction costs and updated property limits. Co-insurance doesn't just apply to buildings, it applies to a variety of other policy conditions and extensions as well. It applies to contents, equipment, stock, contractors' equipment, business interruption, miscellaneous property, transit, and even garage auto programs. So we're spending a lot of time right now with clients trying to evaluate and assist them in evaluating what the value of their property actually is. There are coverage solutions to co-insurance to mitigate and avoid these penalties. Many insurers did, and some still do, offer stated amount co-insurance with a professional evaluation or reconstruction report. Some, but very few, still offer guaranteed replacement cost. Building, you can get property of every description forms, which remove the requirement to determine the difference between buildings and equipment. Actual loss sustained coverage, where there's not a specific limit on business interruption coverage, no co-insurance whatsoever, or other policy conditions that seek to remove these types of cover, the penalty clauses altogether. In addition, there's other key coverage extensions that can be critically important. Removal or deletion of the same site clause on a building policy removes the requirement for you as a client to rebuild the building on the same property that you have now. Blanket bylaws coverage allowing for the increased cost of construction due to changing building bylaws. Inflation protection. Inflation protection is a significant issue right now, and various policies address it in different ways. But one policy is not like the other. There can be very significant differences in what the scope of coverage is. We touch on very briefly, given that businesses have significant demands on their cash flow, environmental risk, and I'll go through why environmental risk can be so significant, who needs coverage, and why. Environmental risk is significantly different than other types of risk because the costs of mitigation from an environmental risk are current, meaning that they need to be paid almost right away and they're significant. Exposures to loss can come from first party, meaning environmental incidents at your site, come from third parties, meaning damages leaving your site affecting third parties, regulatory and legal compliance from government authorities, and other business risks. Environmental risks are strict liability, meaning that there's no element of negligence required. And the Department of Environment has a very broad mandate as to who can be drawn into an environmental claim. The owner of the contaminant, the person having control of the contaminant, the person who, in the opinion of the minister, can act or assist in control of the site, any person who owns, leases, manages, or is charged with control of land, authorities having jurisdiction over land, any person who, in the opinion of the minister, can lend assistance. So it's a very broad array of almost everybody involved in an environmental loss. Every commercial general liability policy has some element of exclusionary language within it, ranging from the most severe to less severe. Absolute or total pollution exclusions seek to exclude all environmental liability and claims. Standard pollution exclusions offer some limited coverage, and the coverage is triggered based on the absence of an exclusion rather than specific intent to provide coverage. Environmental liability policies are much more clear and are triggered by specifically by the presence of a pollution condition. I'm not going to go through a complete comparison of general liability coverage to specialized environmental liability coverage, but I'm going to talk on a few brief points that expand what environmental liability covers, from petroleum and chemicals to other types of environmental damages. That can be mold and indoor air quality, other types of fungal derivatives, and specifically these policies cover fines and penalties issued by government authority. There's a variety of environmental policies available to almost anybody that has an exposure. Premises pollution policies cover basically the premises and the operations at a specific premise. Tank-specific insurance policies cover specifically environmental tanks. There's also coverage for off-site environmental exposures for contractors and other types of professionals. I encourage everybody on the call to carefully evaluate environmental risk, as these claims aren't frequent but can be extraordinarily severe and expensive. Business interruption has been a massive topic during the COVID-19 pandemic, and policies can be traditional or address specifically emerging risks. We've been asked a lot of questions about COVID-19 and business interruption policies. It's still not clear on how all business interruption policies will be interpreted in terms of what they covered during COVID-19. But through the course of the rest of this year, insurers are adding very clear COVID-19 exclusions to their policies. There's increased inventory and supply chain uncertainty during the pandemic, meaning that after a loss, even after properties are restored, it may be very difficult for businesses to resume normal operations, and they may have extended delays until they can do so, not by funding to replace the property or the actual loss, but also due to delays caused by COVID-19. There's increased costs of labor related to reconstruction of property, reconstruction of the loss, and a variety of other issues surrounding any type of loss. The availability of skilled contractors and trades, availability of other suppliers, additional costs and restrictions caused by COVID-19. So just as a general example, we've seen this year getting anybody from outside of Atlantic Canada into Atlantic Canada that offers specialized services like restoration of production equipment can be either significantly delayed or less available. We're seeing significant delays after insurance losses, even when they're properly funded, in resuming operations for a client. So important things to know about business interruption coverage: it's triggered by an insured peril only. It's not triggered by any cause for disruption of business operations. Basically, coverage under a property and liability policy is a follow form. If there's no underlying coverage, there's no business interruption coverage either. Be aware of exclusions and limitations. There's several different wordings and options offered, and it's available on several policy forms in addition to property. Business interruption policies have several key exclusions and coverage can be added back in. Typically, all the things on this list are excluded under a typical business interruption form, but can be specifically added back in. These are things like ordinary payroll. Ordinary payroll under a business interruption form really didn't receive a ton of attention traditionally, but there should be a huge focus on this right now with the lack of skilled labor and availability. You can add into your coverage to maintain your payroll for your employees in the event of a loss. To give a really brief example, if you sustain fire damage to a building that has specific or specialized operations, even if the building could be rebuilt, it may be difficult to attract the employees back, especially if you're not able to maintain payroll. Contingent business interruption coverage covers physical loss or damage that would have been covered by your policy at the location of one of your suppliers. So when I say coverage as a follow form, losses like sewer backup, flood, fire, equipment breakdown typically will trigger business interruption coverage as well as restoration of your property. When we say it's triggered by an insured peril, it's only one of the losses or specific perils that are covered under the policy. Coverage won't respond to a situation where there wasn't insurance coverage against the cause of loss or damage or interruption to your business. Examples include blocking of a neighboring site to your premises. If you suffer a cyber breach that interrupts your network, if there is no cyber coverage in place, water that seeps into a foundation through a wall crack or other foundation issue that could cause disruption of tenants or other operations. So it's very important to understand what coverage is in place in addition to business interruption coverage and how that coverage is triggered. Business interruption coverage isn't only available under property policy, it's also available under several other policies. Standalone equipment breakdown, so sudden and accidental damage to your equipment, especially in a production facility. It's available under cyber liability policies if you lose access to your network or to your operating systems, and under environmental liability policies. So those on the call that are operating fuel services stations or any property which could have an environmental incident which could disrupt their operations. In addition to compensation for loss of revenue or operating, there's other expenses that are particularly pertinent to the current operating environment. So other coverages to look under business interruption can include extra expense and temporary operations of offices or other property, expediting expenses such as air shipping or increased shipping costs to replace products or services relevant to operating your business, tenant relocation expenses if you're a landlord or somebody else that depends on rental income, where it may be difficult to attract new tenants that could pay to house them in temporary locations while your property is restored, or other crisis management expenses and resources. Network security liability coverage is a coverage that I'm also going to talk about briefly on this call, due to the fact that there's been a fairly significant increase in cyber losses and a very pronounced increase in cybercrime and cyber attacking globally. So in addition to the increased risk around cyber liability and private information that existed before COVID-19, there's some specific variables that we've observed and have been widely broadcast in the media relating to cyber losses. So at the start of COVID-19, working from home or telecommuting became extraordinarily popular, and it became necessary for businesses as airlines to continue their operations. With this came a very specific host of problems. These included accepting older software on personal devices that employees may have been using to operate within the operations of the business, procedures and policies not applying to new operating environments, antivirus or firewalls not in compliance with corporate standards or requirements, no encryption, not changing passwords as often, IT audits not being completed, and increased crime and hacking events. I've read statistics that indicate that cyber attacking and cyber incidents have increased by as much as 4,000% as cyber criminals globally have become aware of these operational changes within businesses and really set to capitalize on those changes. So the cyber risk can be divided into different categories. Cyber and e-media risks, network security risks, meaning access to networks, cyber extortion risks, and these are very widely publicized as well, where the criminals access a system and lock it down and demand ransom or other actions in order to release data back to a client. Privacy breach expenses, those costs that exist to rectify situations where people's private information has been accessed, and most significantly, network interruption, where an organization's lost access to its network. Some exposure, some organizations are at much greater risk than others. This is a really great list of criteria to help you determine, is your organization a target for cyber activity? So any company sending, receiving, or storing private information, especially under non-disclosure agreements, where there's a contractual agreement to safeguard private information. Organizations with specific statutory privacy obligations, organizations dealing with financial information such as credit card statement information, especially those with exposure to public or private companies, organizations dealing with intellectual property, trade secrets, designs, recipes, etc., organizations dealing with sensitive personal private information. So for those on the call, it can certainly include engineering firms, financial services firms, retailers that store credit card information, even landlords, residential or commercial, that may have some of this data. There's a variety of different coverage options available to add in relief for clients that have exposure to cyber risks. It can be bought on a standalone policy. It can be bought as extensions of directors and officers liability or commercial general liability coverage. In the current environment, we're encouraging as many clients as possible to buy a standalone policy, because a claim under a standalone policy doesn't affect their loss history under their main policies. The coverage is the most broad. Other limits aren't affected. This is the best way to get cyber coverage in place. Failing that, there are coverage extensions available elsewhere. You can divide coverage into two categories: third-party liability, almost like it can be very easily compared to auto insurance. So if there's a cyber breach, usually the organization has an obligation to a third party. These include notifying the third party, crisis management expenses, credit monitoring and data recovery, and cyber investigation expenses. We have seen claims in Atlantic Canada now, and claims during the COVID-19 crisis. Often, some of the first party losses, like cyber extortion, are the least expensive. Of the claims that we've seen and personally been involved with, once you regain access to your system, determining and undergoing a forensic audit to determine what information has actually been accessed, developing a plan around notification, consulting publicity and legal professionals can really drive the cost around those issues. Also, many businesses, in the absence of cyber insurance, just don't have access to the specialized resources. So if you picture a cyber loss occurring on a Saturday or a Sunday, to go out and find a currency broking firm that can give guidance on Bitcoin, to pay ransom, to access legal counsel in short order that has expertise around cyber attacks to gather up a forensic investigation firm that has specific experience can be a daunting task. Cyber insurance programs offer access to those resources, and they also offer very specific first-party coverages, which can be critical. Business interruption is available under a cyber form, which covers the actual loss or extra expense involved in the loss of access to the network caused by a hacking event. Digital asset loss involves costs to restore or recollect your digital assets, and cyber extortion can actually pay to negotiate ransom and expenses related to a cyber threat. So I really wanted to be careful, given that the fact that it's so well publicized in the media, the effects of cyber attack and the costs related to them, what coverage is available to businesses. I'm going to go through some loss control considerations that we publicized earlier in the year. In addition to coverage, most clients are asking us what they can do to minimize the possibility of getting involved with a cyber incident and how they can minimize the impact. So this list of 6 loss control suggestions that we've put forth can be critical. Follow a formalized disaster and contingency planning process. When a lot of businesses sent their employees home, they didn't reflect back to disaster planning, what that looked like in a formal procedure. Consult with your firm's IT services providers for work from home changes to IT systems. Review cyber and privacy breach applications with your insurance advisor or broker for changes that you're making and what you may have reported if you have cyber insurance in place. Ensure devices such as laptops, tablets, or cell phones have password protection if company email or other software is added. And these include both personal and corporate hardware. You may notice in the media that several corporations have asked or required their employees to remove certain applications from their personal and corporate devices in the midst of some of the cyber hacking issues that have gone on. Don't allow the use of personal email accounts for corporate communications or other corporate business, and maintain vigilance regarding phishing emails and phone calls to staff. So while New Brunswick and Atlantic Canada has had some return to business as usual, more so than other parts of the country, we're seeing second waves, and the implementation of work from home procedures may occur again. That could cause an increase in cyber risks and offer the ability to redeploy in a more effective way work from home environments for a second time if a second wave comes through of COVID-19. The last area that I'd like to touch on insurance and what we see is critical coverage in the current environment is management liability, otherwise known as directors and officers liability insurance. A commonly asked question right now by business owners, directors, and officers is has my risk changed? What's protecting me against those risks? And how do I manage being a director, officer, or business owner in the current environment? So COVID-19 has specifically brought different risks for executives and business owners. There's a greater risk of insolvency, and we're seeing that nationally. Workplace health and safety protocols have become much more complicated to navigate. There's a rapidly changing legal environment, changing regulatory environment, and economic and financial fluctuations ongoing. Every director or officer in a corporation has 3 basic duties: the duty of due diligence and care, the duty of loyalty, and duty of obedience to act within the organization's bylaws. They have statute responsibilities that can result in non-compliance with organizational statutes and failure to act under statutes. Directors and officers policies essentially have 3 different aspects of coverage which can be critical. Side A coverage is the non-entity side of coverage, which affords coverage directly to a director or officer of an organization. It's extremely critical when the organization is not legally required to indemnify a director or officer. So essentially, this part of the directors and officers liability policy will pay claims directly on an individual's behalf when the organization can't or won't afford legal costs. Side A coverage is entity coverage, which reimburses the corporation itself for expenses associated with directors and officers liability. So the business itself can be required to provide costs and expenses to defend directors and officers from litigation. This section of the policy reimburses the corporation. Finally, side C is entity coverage for corporate securities, which is the corporate securities section of the directors and officers liability policy. Every corporation typically issues corporate securities. Examples include notes, stocks, bonds, deposits for security, investment contracts, etc. More and more, there's less distinction between the corporation, among regular authorities, and more association of the directors and officers specifically tasked with making decisions on the corporation's behalf. So there's some key sublimits of coverage that apply, and those really are public relations costs, investigations costs, criminal or penal proceedings, formal inquiry investigation, privacy breach, or other types of costs. Sources of claims include employees, clients, customers, other types of regulatory authorities such as CRA or Department of Environment, shareholders, lenders, and other financial institutions such as creditors. So in this environment, who should have coverage? Any new or mature organization. Coverage really applies from the date that the policy is put in place, so it can be especially important to a new organization. Public companies, private companies with multiple board members or single board members, nonprofit organizations, or other types of public entities. One of the main messages we really want to get across is coverage for specific incidents can come from multiple policies, not just one. These really fit together like a Venn diagram, filling the exclusions of one policy with the scope of coverage of another. So one policy now, given the complexity of today's legal environment, may not be enough to adequately cover off a specific risk issue. As we went through in the presentation, business interruption can be covered under a variety of policies, not just property policies. Network security, environmental policies also afford business interruption policies. Cyber and technology policies as well. So what I hope to accomplish in the presentation today was to review the current state of the market, how insurance specifically applies to COVID-19 challenges, some of the most critical policies that are available to clients, and what you can do to help manage and navigate insurance costs and avoid surprises for uninsured and uncovered losses. So with that, I'll just open for any questions that may come from the group.
Thank you so much, John. We've got a few questions here. So the first question is there a way to review your insurance like an insurance consultant? Who would ensure that you are properly insured at every level, property, interruption, cyber, so as not to get a $200K settlement on a $400K claim, as you noted in one of your examples? Every company has different products and pricing, and it is hard to know if you're properly covered, and it's difficult to come up with all the what ifs.
Yeah, so I'd be glad to field that question. That's the most important role that we serve as an insurance advisor, as brokers. So a lot of people think of the broker's role and responsibility as going to market and providing pricing and premiums. What I'm going to do is just really quickly flip back to one of my visual graphics here that this is the process that a qualified broker really should run you through when we're looking at those. It doesn't start with the insurance program and what's available. It really starts with the organization's specific situation. So I'm going to take this $400,000 loss and $200,000 payout and relate that back to a real estate company. Right now, we're looking at, how has risk changed for a real estate company? It's changed significantly because the costs of construction have risen consistently and sharply within the last year. So we really need to understand where is the risk, and in this case, it's asset-based risk. We're going to hone in on the fact that that's the case. We're going to manage the cost by appropriate deductibles, and we're going to deploy certain loss control initiatives like property valuation, whether that's a professional appraisal or using proprietary software to determine building valuations. We're going to use that understanding to go to qualified insurance companies and work with them to say, hey, you know what, the purpose of a penalty clause was to avoid underinsurance. We've done a lot of reasonable due care and due diligence to make sure that that's not the case. We'd like to adapt the policy conditions specifically for this client. If you take your example of the multiple things that can affect a different client, we're going to work with that client to say, what is your exposure to these different categories? If it's a property management or a real estate company, what type of data are you housing on your servers and records? It could be not much, it could be minimal, there could be a great loss control. Loss control could be an issue. We're going to go through each category of this and build out a risk management plan, deploy some of these different services that are available, and put together basically the specifications that drive what are we pricing in terms of insurance. The other thing that I think I can tell you that will help guide you in that process, as brokers and insurance advisors, it's no longer adequate for us to have a detailed understanding of insurance. We really have to understand your specific business and industry. So if we're serving construction, we have to understand how to read construction contracts, how to identify restrictive clauses, anticipate what type of property and operations that you might have, and that drives us to design an adequate insurance program. So my advice, if you have questions, if you think you're not covered properly, if you think there are unaddressed risks within your insurance program, find a qualified broker that can offer you a review of what you have and give you guidance around how your program should be set up. That really should include a written plan, written feedback on how the coverage program could be designed or what should be in place. And that will help you best test, does the insurance broker know your industry? Do they have good technical knowledge of theirs or not?
Perfect, thank you. We do have a question here about the slides. Would you be able to share those with those in attendance today?
Yeah, I don't see why we couldn't share with the Fredericton Chamber of Commerce.
Perfect.
I'd be happy to do that. I know it was a lot of information, but I wanted to make sure that I touched on something that was useful to almost everybody in the group. And I'll also offer that if Tanya or Krista want to put anybody in the group that has questions in touch with us, that we would be more than happy to connect with individuals to give them more information about a specific topic or specific advice.
Perfect. And just to remind everybody as well, we are recording this and it'll be up on our YouTube. So we do have a comment here from Krista stating that the Chamber is offering a new benefit through CIRA, which is the Canadian Internet Registry Program, providing ongoing cyber safe training for employees at a discounted rate. It's through the Canadian Chamber, and the actual training and dashboard is provided by our local company and chamber member, Beauceron Security. We are proud that they were chosen as the national provider for this service for the Chamber's coast to coast. And I know that as chamber staff, we are doing the training as well to make us as safe when it comes to cybersecurity as possible. And if there are no more questions, I don't see any. If anybody wants to ask a question, feel free to turn on your mic right now. No? Perfect. All right, so we'll wrap it up. Thank you so much, John, for the presentation today. And thank you, everybody in attendance. Thank you, those who are watching this at home. And we'll see you for our next webinar.
Thanks for having me.
Thank you.